You know, it's one of those moments that just makes you scratch your head as an investor. A company puts out what looks like fantastic news, and then you watch a stock just completely fall off a cliff. Well, that is exactly what happened with the investment giant Brookfield Corporation. And we're going to unpack that whole paradox right now.
So picture this, November 13th, the market opens, the earnings report is out, and investors just hammered the sell button. The stock plunged over 6.5% in just one day. I mean, that is a brutal reaction. So what on earth could have happened to trigger a sell-off like that? Well, this is where it gets really weird. The headlines that came out that exact same day were telling a totally different story. They were celebrating. They were saying Brookfield had actually surpassed its earnings estimates. So, what gives? All right, so this is the paradox we're diving into. Good news on paper, but a terrible reaction from the market. There's this massive disconnect between the company's performance and how investors reacted, so let's get into it. Okay, so the big number everyone's looking at for Brookfield is something they call Distributable Earnings, or DE for short. Just think of it as the cold, hard cash they have on hand to give back to shareholders. And on that front, they absolutely crushed it. Wall Street was expecting about 59 cents a share. Brookfield delivered 63 cents. That's a solid beat, no question about it.
So to really get why the market freaked out, we first have to understand just how good the good news actually was. Let's build a case for the bulls here because honestly, the numbers are pretty spectacular.
First up, the big one. Over the last year, Brookfield generated a staggering $6 billion in these distributable earnings. And remember, this isn't some fuzzy accounting number. This is a measure of real cash flow that's available to investors.
And it wasn't just a static, huge number. It was growing fast. We're talking 18% per share growth in their core earnings power over the last year. I mean, for a company this massive, that's just incredible growth.
Now this is all about firepower. Brookfield is sitting on a record-breaking, almost unbelievable $178 billion war chest. That's cash ready to go out and make new investments. In a shaky economy like this, having that much dry powder, as they call it, is a gigantic advantage.
And it didn't stop there. I mean, look at this. A record quarter for raising money. Their asset management fees, a new high. Their insurance business, growing like a weed. And even in this tough real estate market, their absolute best properties are nearly 100% full. On paper, this thing is a fortress. So, if everything's so rosy, why did the stock get hammered? Well, to figure that out, we have to look past the big headlines and see what the bears were looking at. It's time to go find the cracks in that fortress.
Right. This is the million-dollar question, or in this case, the multi-billion-dollar question. If the company is so solid, why are investors so spooked about? Turns out, the devil really is in the details.
And you know, sometimes the smartest insights come from everyday investors. A user on Reddit, Katoon, totally nailed the first big issue. Sure, the annual growth looked amazing, but if you zoomed in on just this quarter, the growth had slowed, way down. Okay, and just a super quick reminder here, because this term is key. Distributable earnings, DE, that's Brookfield's #1 metric. It's the cash they can actually use for dividends or buybacks. So you can bet that any sign of it slowing down is going to raise some eyebrows.
And this chart just lays it all out perfectly. Look at the left. That's the awesome 18% growth over the last year. But then look at this quarter, just 6%. Now, for a company that's been telling everyone to expect 15 to 20% growth, a 6% quarter feels like you just slammed on the brakes.
The next little crack showed up in their insurance business, which is supposed to be a huge growth engine for them. Their goal is to make a 2% profit margin. That's 200 basis points on their investments. But right now, they're only hitting 1.65%. It's a subtle detail for sure, but it's a sign that one of their key engines isn't quite running at full power yet.
And on top of all that, you've got the big picture worries. You know, high interest rates are a risk for any investment firm. And as Brookfield gets bigger and bigger, it just gets harder to keep growing at those super high rates. That's the law of large numbers. Plus, they've got this big acquisition in the UK that's still waiting for the green light, which just adds another layer of uncertainty to the mix. But here's the thing. While the market is busy freaking out about one quarter, Brookfield's management is playing chess, not checkers. They're focused on a much, much longer game. They're not just investing in today, they're investing in what they call what's next. And when they say ambitious, they mean it. They're moving to take full control of Oaktree to basically dominate private credit. They're making a huge $80 billion bet that nuclear power is coming back in a big way. And they're jumping right into the future, partnering on humanoid robotics to bring AI into the physical world.
These are not small, timid bets. This is swinging for the fences.
And if you want to get a sense of just how big they're thinking, listen to this quote from the CEO, Bruce Flatt, about their nuclear investment. He thinks Westinghouse alone could end up being worth over $50 billion. That is the kind of massive, game-changing value that the market, with its focus on the next 3 months, might just be completely missing.
So, this all brings us back to the main event, right? Is this big stock drop a real warning sign that growth is stalling out? Or is this a massive opportunity created by a market that can't see past its own nose?
Okay, so here it is, the whole tug-of-war on one slide. On one side, you've got the bulls, looking at these huge, visionary bets and that mountain of cash. On the other side, you've got the bears, pointing to a single slow quarter and all the risks out there. And you know what? Both sides have a pretty good argument.
But there's one last crucial piece of evidence to look at. Forget what they're saying for a second. What is management actually doing with their own money? The answer couldn't be clearer. They are buying back their own stock, and they're doing it aggressively. That's them screaming to the market that they think their stock is dirt cheap.
And wow, this chart just says it all. Look at this. Management has been buying back stock at an average price of $36 a share. Even after this big sell-off, the stock is still around $44. But here is the absolute kicker. Management's own calculation of what the company is truly worth, $69 a share.
And so that leaves us with this one final powerful question. The people who know this company inside and out, they are buying shares at what they believe is almost a 50% discount. So who's right? Is the market right to be nervous about the short-term hiccups? Or is it completely blind to the long-term masterpiece management thinks they're building? And that, right there, is the Brookfield paradox.